Capital market securities. Capital market securities are financial instruments that are issued by corporations and governments to raise capital. These securities can be in the form of debt securities, equity securities, and derivatives. Capital market securities give investors the opportunity to build wealth over time by investing in diversified assets and earning returns on those investments. Debt securities. Debt securities are fixed income instruments, such as bonds, that provide the holder with a predetermined stream of payments over a certain period. Debt securities are generally issued by governments and corporations in order to raise capital for projects or operations. Debt securities can be either short-term, maturing within 1 year, or long-term, maturing beyond 1 year. Common types of debt securities include government bonds, corporate bonds, and asset-backed securities. Debt security holders have priority over equity holders if there is ever a situation where creditors must be paid first in order for debts to be settled during market downturns or bankruptcies. When investing in debt securities, it is important for investors to consider various factors, such as credit ratings, which measure how likely an issuer is able to pay back its obligations, yield spreads, differences between what a bond pays versus similar investment-grade bonds, and duration, the length of time until full repayment. Government bonds are debt obligations issued by governments to fund public projects such as schools, roads, bridges, and hospitals, as well as to supplement government budget. In most countries, these types of investments offer tax benefits to investors since the interest earned is exempt from federal taxes. However, it is important to note that government bonds tend to have lower returns compared with other investments due to their low-risk nature. Corporate bonds are debt securities issued by companies to raise capital for projects or operations. They generally offer higher yields than government bonds, but carry greater risks since the issuer is a private entity and not backed by the government. Asset-backed securities, ABS, are financial instruments backed by specific assets, such as mortgages, auto loans, and credit card receivables. It provides monthly cash flows when payments on those underlying assets are received. Asset-backed securities or ABS typically come with higher yields than traditional fixed-income investments because they involve greater risk due to their dependence on principal repayment performance of underlying assets. Equity securities. Equity securities are capital market securities that represent ownership stake in a company. Equity security holders are referred to as shareholders or stockholders, and have the right to vote on certain matters and decisions regarding how the company is run, receive dividends from profits, and share in any capital gains should the value of their shares increase. Investing in equity offers potential for growth through appreciation of underlying assets and dividends paid out by issuers when profits exceed expenses. However, this also involves greater risk than debt securities since there is no guarantee that returns will be realized due to market volatility or changes in issuer performance. Common stock is the most common form of equity security and represents an ownership stake in a company. Common stockholders are able to vote on certain matters related to how the company is run, electing board members, approving mergers and acquisitions, setting executive compensation packages, and may receive dividends from profits. When the market value of their shares increases, they also share in any capital gains that result. Preferred stock is another type of equity security that gives holders priority over common shareholders if the company were to liquidate or go bankrupt. They typically do not have voting rights but instead offer fixed dividend payments with higher yields than those offered by common stocks. Additionally, preferred stockholders may have an option to convert their shares into common stock at a specified price at a future date. Overall, investing in equity securities provides investors with access to high-growth opportunities while still allowing them to diversify away from more traditional assets such as fixed-income instruments. This makes them ideal for those looking for higher returns or who want exposure to industries where growth prospects appear promising. Derivative securities. Derivative securities are financial instruments that derive their value from an underlying asset, such as a stock, bond, commodity, or currency. Investors use derivatives to hedge against risk and speculate on the direction of price movements in markets. Derivatives allow investors to leverage their investments by taking larger positions than they would otherwise be able to with just cash. This increased leverage can generate higher returns from smaller investments but also carries greater risks of losses. Options are derivatives that give the buyer, holder, the right, but not the obligation, to buy or sell an underlying asset at a set strike price before an expiration date. Options offer investors flexibility and control over their investments because they can choose how much of their money is exposed at any given time depending on whether they decide to exercise their option or let it expire worthless. This makes options attractive hedging instruments when used correctly since buyers have limited downside risks while still being able to leverage potential profits from market movements in favor of their position. Futures are derivative contracts that obligate parties to buy or sell a certain asset at a predetermined price on a specified date in the future. Futures provide investors with a way to manage price risk by allowing them to lock in prices for commodities, currencies, and securities that may be volatile or difficult to predict. They can also be used as an effective tool for speculation as they allow traders to take positions on various assets without having to actually purchase them outright. Forwards are similar in nature compared with futures but differ mainly due to their customizability. Forwards contracts have more flexible terms than standard futures, including customizable delivery dates, settlement methods, and payment schedules, which make them ideal for companies seeking tailored agreements between themselves and other parties involved in transactions such as currency trades or commodity purchases and sales. Swaps are derivative contracts between two parties to exchange one financial asset or obligation for another. Swaps involve the simultaneous purchase and sale of a set of cash flows from two different parties, oftentimes at different prices. It allows each party to gain exposure to the desired market without having to own the underlying security or instrument itself. The most common types of swaps are interest rate swaps, currency swaps, and commodity swaps. In summary, capital market securities offer a variety of opportunities for investors to diversify and grow their portfolios. Debt securities provide investors with steady income while also providing some protection from volatility due to their fixed nature. Equity investments come with potentially higher returns compared to debt securities and are ideal for those looking for exposure to high-growth industries or seeking an additional layer of diversification within their portfolio. Derivatives offer numerous benefits in terms of hedging risk and providing access to certain asset classes otherwise unattainable through traditional investment methods alone. Ultimately, it is important that individual investors carefully consider all options before making any decisions so they can select the best instruments suited towards meeting their long-term financial goals. Thank you for watching. Hope to see you all on the next one.